You've probably noticed something lately that's hard to describe until you feel it in your own account. It's not just that prices are moving, it's that markets are moving like they're on a hair trigger. Like the room is quiet, the music is still playing, people are still smiling, but the exits suddenly feel important. And when you see gold sitting above a level like 5,000, when that number becomes normal enough to print in a headline, your brain does what every human brain does. It tries to compress a complicated system into one simple story. Gold is up because inflation. Gold is up because fear. Gold is up because the dollar is weak. Gold is up because central banks are buying. Gold is up because war. Gold is up because recession. Sometimes those are partially true. Sometimes they're true in the way a fortune cookie is true, vague enough to fit any day that feels dramatic. But if you want to understand why gold above a psychological threshold can flip markets fast, you have to stop treating gold like a single-factor trade, and you have to stop treating the dollar like a mood, because the real story, the one that flips markets, doesn't start with gold. It starts with the unit everything is priced in, the measuring stick, the default, the thing people run to in fear, the thing global debts are denominated in, the thing central banks hold, the thing collateral is built on, the dollar. When I say the dollar trigger, I don't mean the dollar is down 0.5% today and somebody wrote a dramatic tweet. I mean the dollar stops acting like a stable default and starts acting like a variable that needs to be hedged. That's the trigger, that's the flip. And when that flip happens, it doesn't stay in FX. It doesn't stay in a currency chart that normal people ignore. It spills into everything. Bonds, stocks, credit, commodities, crypto, real estate, everything that depends on the price of money and the trust in promises. So today I'm going to do something most coverage won't do. I'm going to explain in plain English what gold above 5,000 actually signals, why the dollar trigger matters more than almost anything else in macro, how it can flip markets fast, and what measurable signs you can watch so you don't get emotionally whiplashed by the next headline. Quick check-in before we start, comment one word: dollar or trust. Which one do you think is the real backbone of markets? One word: dollar or trust. Then we move. Okay, let's start with the most important idea in this entire video. Gold is not just an asset. Gold is a report card on confidence. And confidence is layered. There's confidence in growth, confidence in inflation, confidence in policy, confidence in liquidity, confidence in collateral, confidence in settlement, confidence in the ability of institutions to keep the machine stable. When gold is quietly rising, it can be normal portfolio behavior. Diversification, insurance, a mild hedge. When gold is surging through huge psychological levels, it often means the market is repricing the cost of trust. And when the cost of trust is repriced, the rest of the system doesn't stay still. Because every asset you own is ultimately a claim on something. A claim on future cash flows. A claim on a business. A claim on a government's ability to pay. A claim on a bank's ability to settle. A claim on someone else's promise. Gold is the asset you hold when you want less exposure to the promise stack. That doesn't mean every person buying gold is panicking. It means the system is pricing some degree of uncertainty into the unit of account and the credibility of the stack. Now the second important idea. Gold is not a one-factor trade. It's a tug of war. One side is opportunity cost. That's yields, real rates, the carry you give up by holding an asset that doesn't pay you interest. The other side is trust demand. That's fear, currency risk, policy credibility, systemic anxiety, and the desire to own something outside the promise stack. When gold is moving gradually, the tug of war is balanced. When gold is moving violently higher through milestone levels, trust demand is overpowering opportunity cost, or opportunity cost is breaking down in a way the simple narratives don't capture. That's why you can see gold rise even when yields are high. That's why you can see gold rise while stocks still rally. That's why you can see gold rise while the world seems fine. Because gold doesn't wait for disaster. Gold responds to the wobble. Now why does the level matter? Because levels are not just technical, they're psychological. A level like 5,000 becomes a magnet. It becomes a conversation. It becomes a narrative anchor. And narrative anchors change behavior. Here's how. A big level gets written about. Coverage attracts attention. Attention attracts new participants. New participants change liquidity. Change liquidity increases volatility. Volatility changes collateral and risk controls. Risk controls force behavior. So a big gold level can become an accelerant. It doesn't just reflect a regime. It can help create the conditions for faster moves by pulling in more emotion and more positioning. And the reason that matters is because the fastest flips in markets happen when positioning gets caught. Markets don't move because you and I have opinions. Markets move because large portfolios must rebalance when assumptions break, and the dollar trigger is one of the biggest assumption breakers in the global system. Now let's get very clear about what the dollar is in this context. People talk about the dollar as if it's just a currency used by Americans. That's not how the world works. The dollar is a global settlement layer, a funding currency for international borrowing, a collateral base in many markets, a reserve asset held by institutions globally, a pricing unit for commodities, a reference point for risk premiums. So when the dollar changes behavior, it changes global money behavior. And global money behavior is what flips markets. Now here's the simplest way to understand the dollar trigger. Most global portfolios have an invisible assumption. The dollar is the default safe parking spot. When risk rises, money runs into dollars. When stress hits, people scramble for dollars. When uncertainty spikes, dollars tighten. That's the classic pattern. But there are moments, rare but real, when the dollar stops being a pure safe haven default and becomes a variable that people hedge or reduce. This doesn't mean the dollar dies. It means the dollar loses some of its automatic premium. It becomes more volatile. And volatility in the unit is like shaking the foundation of a building. Everything above it moves. Now what causes that flip? The dollar trigger is usually not a single event. It's a cluster of conditions that makes global players reassess the dollar's risk profile. Let's go through the most common triggers, but we're going to do it in a way that's useful, not a history lecture. Trigger type 1, policy credibility stress. If markets start believing that policy is less predictable, less disciplined, or trapped in conflicting goals, the currency can become less stable in expectation. Currencies trade expectations as much as they trade today's reality. If the expectation becomes more uncertainty, hedging demand rises. Gold likes that. Trigger type 2, debt dynamics turning from background noise into a variable. When a government borrows a lot, that's not automatically a crisis. But if the market starts asking who is the marginal buyer, and at what yield, those questions can become destabilizing, because they touch the ecosystem of safe assets, and the dollar's global role is tied to confidence in that ecosystem. Trigger type 3, foreign flow shifts. You don't need the entire world to change its behavior. You need the marginal flow to shift. Markets move at the margin, not at the average. If the marginal buyer of dollar assets steps back, or if repatriation flows increase, pressure on the unit can change. Gold is a natural hedge against that kind of flow uncertainty. Trigger type 4, funding and collateral stress that forces policy responses. There are times the world scrambles for dollars because dollar-denominated debt and settlement needs create a dollar shortage. In those moments, the dollar strengthens and gold can struggle initially because everyone is selling what they can to get cash. But if the response to that stress is massive liquidity provision, the narrative can flip fast, from shortage to excess. That's when you can see fear in a weakening unit at the same time, an explosive setup for gold. Trigger type 5, global diversification and hedging becoming a trend. Again, not dramatic, quiet, incremental. More hedging of dollar exposure, more diversification of reserves, more hedging of currency volatility. The marginal shift can drive sustained demand for anti-unit assets. Gold absorbs that demand. Now I want you to notice the theme. None of these triggers require an apocalypse. They require a wobble in the unit stability premium. And gold above a huge level can be a market's way of saying we're pricing more wobble. Now let's connect this to flip markets fast. How does a currency wobble flip stocks and bonds and everything? It flips them through 3 channels. The funding channel, the collateral channel, the psychology and positioning channel. Let's break those down. First, the funding channel. A lot of global positions are funded directly or indirectly in dollars. When the dollar moves sharply, it changes the cost of funding and the value of collateral. That forces rebalancing. Rebalancing creates flows. Flows move markets. This is why FX can be the tail that wags the dog. Second, the collateral channel. In stressed regimes, collateral is not just a background concept. It's the steering wheel. When volatility rises, margin requirements rise. When margin requirements rise, forced selling begins. Forced selling is not an opinion, it's a mechanism. And the dollar trigger can increase volatility across multiple asset classes because it touches the unit and the funding base. If you get volatility in currency plus volatility in rates, the system becomes more fragile. Fragility creates fast flips. Third, the psychology and positioning channel. This is the big one. Markets don't move because something changes. They move because people were positioned for the opposite of the change. If the majority is positioned for strong dollar, stable unit, predictable policy, and the dollar begins to wobble, positioning must adjust. Positioning adjustments can be fast. Fast adjustments flip markets fast. Now let me make this real with a simple sequence. Imagine gold breaks above a huge level, headlines explode, and people interpret it as the unit is wobbling. Funds that were under-hedged on currency risk add hedges. Some portfolios reduce dollar exposure. Some reallocations happen toward real assets or anti-unit hedges. Those flows weaken the dollar further. That weakness pressures rates and bond markets in certain ways depending on the regime. Bond volatility rises. When bond volatility rises, risk assets get nervous because the discount rate becomes unstable. Stocks reprice. Credit spreads change. Correlations get weird. And suddenly what looked like gold is up becomes everything is moving. That's the flip. Now here's a common mistake people make when they hear this. They think it means buy gold, short everything else. No, the point is not a simplistic trade. The point is a regime shift. In regime shifts, correlations and relationships can behave differently. Gold can rise while stocks rise if liquidity is abundant. Gold can rise while stocks fall if fear is dominant. Gold can rise while bonds fall if bond markets are repricing credibility. The relationships depend on the lane. So we need a lane map. We need a scenario tree. Not because we can predict perfectly, but because it keeps us from being surprised. Here are 3 lanes that can exist when gold is above a massive level and the dollar trigger is in play. Lane 1. Controlled repricing. In this lane, the dollar weakens gradually, gold grinds higher, bond markets adjust without chaos, and equities can continue to function. You get volatility, but it's manageable. This lane is system adapting. Lane 2. Credibility shock. In this lane, the dollar trigger is tied to credibility, policy confusion, debt dynamic stress, foreign flow shifts, or an event that causes a rapid reassessment of the unit's stability. Gold rises faster, bonds become volatile, risk assets wobble, correlations rise. This lane is where flips happen fast because positioning gets caught wrong. Lane 3. Liquidity spiral. In this lane, stress forces de-risking, followed by heavy liquidity responses. You get violent moves, sell-offs followed by sharp rallies. Gold can rise because trust risk rises, and because liquidity expectations rise. This lane is where people get chopped if they treat the market like a straight line. Now, how do you know which lane you're in? You watch measurable signals. This is where most people fail. They keep watching only gold. Gold is the headline. The signals are around it. Here's the watch list. And I'm going to make it specific. Signal 1. The dollar's behavior, not just its direction. Is the dollar making lower highs and failing to recover after dips? Is buy the dollar dip stopping working? Is the dollar becoming more volatile, with bigger daily ranges? That matters more than a single red day. Signal 2. Gold's strength across currencies. If gold is rising only in dollars, the story can be currency specific. If gold is rising across multiple currencies, it's more likely a global trust story. That's a stronger signal. Signal 3. Bond volatility. Not just bond yields, bond volatility. Bond markets set the price of money. If bond volatility rises, it increases the gravity on all risk assets. If bond volatility is rising while the dollar is weak, the system is louder. Loud systems flip fast. Signal 4. Correlation behavior. Look for the weird days. Stocks down, bonds down, dollar down, gold up. Or stocks down, dollar down, gold up sharply. Those patterns suggest repricing of the unit and the discount rate, not a simple risk-on/risk off day. Signal 5. Liquidity fingerprints. Air pockets, wide spreads, sudden gaps, rebounds that fail quickly, moves that happen too easily, like the market is thin. Thin liquidity is where cascades thrive. Signal 6. Gold's follow-through behavior. In a short-term spike, gold pops and then fades quickly. In a regime shift, gold holds higher levels and dips get bought. Follow-through matters. Signal 7. Inflation expectations relative to yields. You don't need to do complex math. Just understand the idea. If nominal yields rise but inflation expectations rise too, real returns may not improve much. That makes gold's opportunity cost headwind weaker than people assume. Signal 8. Narrative and hedging behavior. This is softer, but it's real. When more mainstream participants start discussing hedging dollar risk, and when that talk translates into flows, the unit becomes a variable. That supports gold. Now here's the fast flip checklist. This is the cluster you should respect. If you see the dollar weakening persistently, gold strong across multiple currencies, bond volatility elevated, risk assets failing to rally on good news, weird correlations, and liquidity turning patchy, then you're in a regime where markets can flip fast. Not guaranteed, but possible. And possibility is what risk management is for. Now let's talk about what this means for you, because without that, this is just interesting talk. If your portfolio is built on stable assumptions, regime shifts hurt. Assumption: bonds hedge stocks. Assumption: dollars rally in fear. Assumption: liquidity is temporary. Assumption: liquidity is always there. Assumption: correlations behave. If the dollar trigger is real, those assumptions can wobble, which means portfolio outcomes can surprise you. That doesn't mean sell everything. It means stop being fragile. And fragility is not I might lose money. Fragility is I might be forced to act at the worst time. So let's talk about fragility. Fragility shows up as excess leverage, overconcentration, short time horizons with big positions, dependency on tight spreads and perfect liquidity, no plan for volatility. If your portfolio is fragile, a fast flip can force decisions. And forced decisions are almost always bad decisions. Now I want to talk specifically about leverage for a moment because it's the silent killer in regime shifts. If you are trading anything with leverage in a high volatility regime, you're not just trading direction, you're trading the risk rules. Margin requirements can change. Collateral demands can rise, liquidity can disappear, exits can get worse. This is why you can be right and still get wrecked. The market doesn't have to beat your thesis. It only has to beat your margin. That sentence is worth repeating because it's the difference between surviving and becoming a cautionary comment. Now, for people who hold gold long term, there's a different risk: psychological. Huge levels create greed, pullbacks create doubt, and in between the market creates noise designed to make you switch your plan at the worst times. So if you're a long-term holder, your job is to remember, gold is a tool, not a mood. Now I want to address one more thing. A lot of people hear dollar trigger, and they immediately run to dramatic conclusions. They start talking like the system is ending. That's not how systems evolve. Systems evolve slowly, then suddenly, then slowly again. The point is not to predict collapse. The point is to recognize regime risk. Regime risk is when the rules you've relied on stop working consistently, and gold above a major level can be a signal that regime risk is rising. Now, because this is supposed to be a voiceover script that keeps retention, I'm going to open a loop that I'll close later. There's one specific reason gold can stay elevated even if the dollar bounces. And it's the reason a lot of people get trapped trying to short gold based on the dollar is oversold. We'll come back to it. But first, let's talk about the two biggest misunderstandings that cause people to interpret gold wrong. Misunderstanding 1. Gold is only an inflation hedge. Gold can hedge inflation, but it's not a simple CPI trade. Gold is a hedge against monetary instability and trust risk. Sometimes that's inflation. Sometimes it's policy credibility. Sometimes it's currency volatility. Sometimes it's real rates. Sometimes it's systemic uncertainty. Misunderstanding 2. Gold moves opposite the dollar always. Gold often moves opposite the dollar, but not always. In crisis regimes, you can get both dollar strength and gold strength, because the dollar is the settlement demand and gold is the trust hedge. These relationships are not religions, they are contextual. Now let's close that open loop I mentioned. Why can gold remain elevated, even if the dollar bounces? Because once the market starts treating currency risk as something to hedge structurally, gold becomes an allocation, not a trade. And allocations don't flip on a dime. If institutions decide they need more anti-unit exposure, they don't buy one day and sell the next because the dollar had a green candle. They build positions over time. That creates persistent demand. Persistent demand can keep gold supported even through counter-trend moves in the dollar. That's why trying to short gold with a one-line thesis like dollar is due for a bounce can be dangerous in regime shifts. Now let's talk about what could flip markets fast specifically. The phrase flip fast implies rapid repricing. Rapid repricing usually comes from forced behavior, and forced behavior comes from collateral. So the real danger zone is when dollar volatility and bond volatility combine, because that combination affects the value of collateral, the cost of funding, the stability of the discount rate, the hedging needs across portfolios. When both volatilities rise, the system becomes more fragile. Fragile systems flip fast. Now I want you to imagine a simple scenario. Gold surges above a huge level. The media declares new era. Retail gets excited, options activity increases, leverage increases. Then the market has a violent pullback day. That pullback triggers stop-outs, margin calls, and forced selling. At the same time, the dollar is volatile. Bond volatility is elevated. Liquidity is thin. That single pullback can become a cascade, not because the long-term story is wrong, but because the short-term positioning became fragile. That's how markets flip fast. Now what should you do with this information? Not in a tell me what to buy way, in a how do I not get wrecked way. Here are the practical behaviors that help in regime shifts. Behavior 1. Reduce fragility. If your position size makes you emotional, you're oversized. Reduce it, you'll think clearer. Behavior 2. Respect volatility. Volatility is not just movement, it changes rules. Behavior 3. Watch the plumbing. Stop staring only at the gold chart. Watch dollar behavior, bond volatility, correlation weirdness, liquidity fingerprints, and gold's follow-through. Behavior 4. Avoid urgency. Urgency is the emotion that produces the worst trades. If you feel urgent, you're not seeing clearly. Now I'm going to give you a simple daily routine. Once per day, ask these questions. Is the dollar stable or volatile? Is gold strong across currencies? Is bond volatility rising or calming? Are correlations behaving or getting weird? Do gold rallies hold or fade? If you do that, you'll be calmer than most people, and better informed than most commentary. Now because this is a long script, I want to add a second open loop, something people care about. If gold is above 5,000, what does that imply for silver? We'll come back to that near the end, because it ties into the dollar trigger and volatility in a really important way. But first we need to talk about one more layer, the narrative layer. Markets are not only mechanics, they are stories that become self-fulfilling through flows. When gold hits a huge level, the story changes. The story becomes gold is telling us something. That story attracts buyers. Those buyers push price. Price confirms the story. The story spreads more. That loop creates momentum. Momentum attracts leverage. Leverage increases fragility. Fragility increases volatility. This is why big levels can create both opportunity and danger. Now let's go deeper on the idea of the unit of account wobble. Most people don't realize how deeply the dollar is embedded. If the dollar is stable, global trade and finance have a stable reference. If the dollar becomes volatile, it introduces uncertainty. Uncertainty creates hedging demand. Hedging demand creates flows. Flows move markets. It's not emotional, it's practical. Imagine you run a company that buys commodities priced in dollars but sells products in another currency. Dollar volatility changes your costs. You hedge. Imagine you run a fund that owns global assets. Dollar volatility changes your returns in base currency terms. You hedge. Imagine you're a central bank managing reserves. Dollar volatility changes your reserve stability. You diversify. Gold becomes a hedge, a diversification tool, an anti-unit. Now that doesn't mean everyone piles into gold, but enough marginal demand can move price significantly because gold markets, like all markets, move at the margin. Now let's talk about the could flip markets fast part in the context of what people usually miss. Time. Markets can stay irrational longer than you want, but fast flips happen when time horizons collide. Long-term allocators move slowly. Short-term traders move fast. When a regime shifts, the slow money often starts repositioning. The fast money tries to front-run it. Retail tries to chase it. Then volatility spikes and collateral forces the fast money to unwind. Those time horizons colliding produces violent movement. Now let's go to that silver open loop. What does gold above 5,000 imply for silver? Silver is the wild cousin. It's part monetary, part industrial, and more sensitive to leverage. In regimes where gold rises because trust risk rises, silver can be pulled up by the monetary narrative. But silver can also be more volatile because it's smaller and more easily whipped by paper flows. So in some scenarios, silver outperforms gold dramatically. In other scenarios, silver lags or gets slapped around while gold holds up. Why? Because silver's industrial sensitivity and leverage sensitivity can create different behavior. The takeaway is not buy silver because gold is high. The takeaway is if gold is signaling regime risk, expect volatility in everything, including silver. Now, I'm going to give you 3 silver-related signals that matter in a gold-driven regime shift. 1. Does silver follow gold on up days but drop harder on down days? That's leverage sensitivity. 2. Do physical premiums and retail availability in silver tighten even when spot whips? That suggests physical demand is strong even if paper is volatile. 3. Does silver's volatility increase meaningfully compared to gold? That can signal speculative froth and fragility. Now I want to add something else people don't talk about enough. In regime shifts, narratives become weapons. People will push simple explanations because simple explanations travel. Gold is up because X. Gold is up because Y. But markets don't move on single letters. They move on clusters. So if you want to survive, you have to resist narrative addiction. You can't let your brain demand one neat story. You need a framework. And the framework is, the dollar trigger is a behavior shift that can change flows. Those flows can reprice multiple markets quickly. Gold above a huge level is often a symptom of the trust demand rising and/or opportunity cost breaking down. Now, let's talk about opportunity cost for a moment, because some of you will be thinking, but if yields are high, why would gold be up? Because yields are not the whole story. Real yields matter. Inflation expectations matter. Risk premiums matter. Currency volatility matters. And most importantly, in stressed regimes, the demand for insurance can overpower the opportunity cost. Insurance is not chosen because it yields. Insurance is chosen because it protects. So if gold is above a huge level, it can mean the market is paying for protection. Now let's talk about the potential turning points that can flip markets fast. There are usually a few. A sharp dollar move, a surprise policy signal, a bond auction shock, a liquidity event in another asset class, a sudden correlation shift, a volatility spike. But again, these are sparks. The real determinant is whether fragility is present. Now, I promised at the start that we'd keep this engaging and practical. So here's the practical what to watch next list, condensed into a simple flow you can remember. Watch the dollar's trend and volatility. Watch gold across currencies. Watch bond volatility. Watch correlation weirdness. Watch liquidity fingerprints. Watch gold follow through. If those are aligned, you're in a regime shift. If they're not, you may just be in a loud but normal market. Now I'm going to talk directly to the person who's thinking, okay, so do I buy gold now? I'm not your advisor, but I can give you the only rule that matters in this environment. Don't be fragile. If you buy anything, gold, stocks, crypto, don't do it in a way that makes you an emotional hostage. If your position size makes you panic on a pullback, you're oversized. And in a high volatility regime, pullbacks are not optional. They are guaranteed. So the right approach is survivability, not bravado. Now, because this is a long video, I'm going to give you one more retention hook. There's a moment where gold above a level like this actually increases the probability of a sudden reversal. Not because the story is fake, because the market becomes crowded and fragile. We'll end on that and I'll show you how to spot that crowding. Now let's talk about crowding. Crowding shows up as everyone speaking with certainty. Everyone posting targets like they're guaranteed. Leverage rising, options activity spiking, pullbacks getting aggressively bought, until suddenly they don't. Crowding is not just a sentiment problem, it's a positioning problem. If too many people are on one side, the market can punish them, and the punishment is usually fast. Now how do you spot when gold is becoming crowded? You can't see everyone's book, but you can see symptoms. Does gold start making big intraday reversals? Does volatility spike without progress? Do rallies become steeper and more emotional? Do dips get bought instantly, like reflex? Those can signal late-stage momentum. Now here's the tricky part. Crowding does not mean sell immediately. Crowding means expect volatility and manage size. Because crowded markets can go further than you expect before they reverse. So don't fight momentum with ego. Respect momentum with risk control. Now let's close out with the core message. Gold above 5,000 is not just a gold story. It's a system story. The dollar trigger is a behavioral shift where the dollar is treated less like a stable default and more like a variable risk that needs to be hedged. If that shift is real, it can flip markets fast because it affects funding, collateral, and positioning across multiple asset classes. And the way you survive that is not by predicting perfectly, it's by staying unforced. Now one final comment prompt, and I'm keeping it to one. Which do you think causes the next big flip? Dollar volatility or bond volatility? One phrase, dollar volatility or bond volatility. And here's the final takeaway, one sentence. When the measuring stick wobbles, the whole room moves, and gold is what people grab when they don't want their safety tied to someone else's promise. If this helped you, subscribe. I'm going to keep breaking down these system shifts in plain English without the circus, because most people don't lose money from being dumb, they lose money from being surprised. And send this to one person who thinks gold is just a commodity. Not to argue, to save them from missing the bigger story. Gold is the anti-unit, and the unit is what can flip markets fast. Educational only, not financial advice. I don't know your situation. Nothing here is a recommendation to buy or sell anything. Manage your risk, make your own decisions, and don't let a big number push you into a fragile position.